Shannon, welcome to Real Vision. Good to see you.
Thank you very much for having me. Pleasure to be here.
And we've been talking on and off for the last few months about Japan, and Japan coming to an important juncture. There's been this sort of financial situation which we'll go into, and which may be a blueprint for financial situations in the rest of the world, particularly Europe. But then also this other element, which is that the consequences of this could have an exogenous shock on the global system. And I think what's really interesting here is when we've been talking about this and Raoul's been looking at it, he talked about this big framework. And most people think of things like trade wars as being the exogenous shock. But the danger is there may be one or two other exogenous shocks out there, which obviously we come to. But to put this all in context, can you outline this sort of financial scenario that eventually could lead to an economic scenario in Japan, and how that's been building, brewing?
Sure. It's a complex beast. There's many moving parts. But one way I've recently, in articulating this to others, tried to simplify it is drawing an analogy. A financial system is like a reactor, a structure that contains interaction between elements. So in the financial system, the dominant elements are borrowers and lenders. Lenders transfer funds to borrowers, and then borrowers transfer that back with interest, hopefully. Sometimes that goes wrong. What we've seen is within that reactor, central banks have been trying to use extraordinary policies to stimulate interaction. And the way they do that is to reduce the flow of interest from the borrowers back to the lenders. And indeed now with negative rates, they've reversed the flow completely. They're trying to stimulate outputs such as inflation. And it's very hard to see and measure how successful that has been. But what we can clearly see is that their interference with the system is creating instability. And what I mean in particular is the lenders, most importantly banks, which have had a in Japan, 0% deposit cost now for a number of years, essentially are just squeezed by the reduced flow back of interest payment. And they have their own outflows they need to pay operating costs, staff, computer systems, regulatory, and that's about 1%. Okay? So the central banks have been reducing that flow and reversing it back out from banks when they put overnight deposits on. And this, in my opinion, is coming to a real head this year. You have to really look at the weakest elements of the banking system, and I believe they are melting down now at accelerating rates. Those are the regional banks. What we're seeing is the most important income source for them to remain viable and cover their own outflows is loan income in Japan. The average new loan interest rate they achieved in May fell from 82 basis points to 64 basis points. Okay? They have about a 1% break even they need to cover those outflows to keep the bank going. And indeed that 1% I think is artificially low, and indeed it's a lot higher. But if we just take that conservative 1%, they've gone from receiving 82 basis points to 64, and they've doubled the shortfall. A doubling in a meltdown is a very concerning acceleration. The real issues at large are tying in with global macro events. We can see the pressures in the system building in other areas, in Europe, for example, where we also have deeply negative rates. And a way to measure this, to see that the pressure gauge in the system, is the amount of negative yielding bonds globally. And that has recently hit a new all-time high of $13 trillion. What adds further pressure for the Japanese banks is they can no longer go overseas to secure yields in higher yielding markets to offset the problems at home. And that's due to some dislocation in the FX forward markets and FX hedging costs. To look at this in terms of numbers, the Japanese banking system, which is the largest net creditor system in the world, now receives negative 70 basis points when currency hedged in 10-year US Treasury yields. So the largest debt market globally for them is unviable. And this is why we are seeing in Japan, with limited options overseas, and we'll talk about later how they have been taking higher risk overseas, but it's not offsetting the domestic issues in Japan, and they are in meltdown. And this is something that I don't think the vast majority of observers are aware of the scale of.
And so, I mean, when we look at the performance of the Japanese banks versus the broad market, it's been in this sort of a record all-time lows.
Yep.
It's been effectively a sort of 40 years of slow death. But it sounds like that slow death, they're now running out of runway. And you mentioned that they're now new loans, or returns on new loans, interest on new loans is below effectively the cost of capital. But sure, that's been sort of building over a while.
Yep.
Are there other elements within this that are creating an acute stress for the Japanese banks, so that the death by 1,000 cuts now becomes death?
Yes. There's three things really coming to a head. One is, so negative interest rates brought the new loan interest rate from around 1.2% to about 1% in 2016. It then flatlined just below that, 17, 18, and then we've seen a big step down now. So that's really come to a head this year. I noticed your colleague Raoul was recently suggesting that negative rates were thought to implode a banking system. We haven't seen it in Japan yet. The reason it hasn't happened yet is the banks have been using accounting tricks in abundance, not just the regional banks, but mega banks in Japan, to obfuscate the effects. And those are running out. In addition to that, they've been hiding non-performing loans and substantial amounts under a government debt moratorium. Just to talk about the accounting tricks to start. So in 2012, when Kuroda and Abe basically said, we are going to crush JGB yields until we get inflation, and those who knew what was going on in Japan knew that they wouldn't create sustainable inflation, so yields would decline precipitously. The banks obviously had substantial JGB holdings. What they've done since 2012 is reduce their JGB holdings as the Bank of Japan has bought them, and shifted a lot of their security holdings into domestic ETFs and foreign fixed income. Okay? The largest area is domestic ETFs that are in private investment trust structures that are an arrangement with brokers that are not marked to market, and whenever they generate capital gains, the banks cancel the investment trust arrangement and reflect the capital gains as interest income under their net interest income line within securities. This is highly irregular under international accounting standards. I was calling it window dressing, but some of the guys involved just straight up call it an accounting trick. The issue with this is that played out well for them in 2012, 13, 14, 15 as the equity markets rallied and they generated capital gains. 16 saw equity markets fall and they got really worried, but then markets recovered late 16 and through 17. Since the early part of 2018, when the Topix index peaked, the market is down between 15 and 20% now. They are not able to generate these capital gains to report as interest income to hide the fact that their loan books are dramatically below break even. They have a stock of unrealized gains that they're running down, but some banks now have completely run out. And a big part of my job is digging through the layers of the onion to get to an estimate of the amount and also the relationship between the unrealized gains and various asset classes. Some banks are more exposed to equity, some foreign credit, and modeling how their earnings will surprise and collapse. And indeed, many have seen earnings surprise to downside and collapse. The whole sector has seen its earnings since 2015 decline by 50%. I believe that they have deeply negative margins on their loans, and as the old loans roll over and the accounting tricks run out, they will be perpetually loss-making banks because it is not like they're seeing a growth in population, they're seeing accelerated decline in population. So conditions are just getting worse on that front. And many of these banks will see their shareholders zero. So there's significant downside to come.
I think one of the other things you mentioned on this was the there's that loan issue, there's the accounting trick issue, but there's also sort of a collateralization issue. So the sort of the old people in the regions which are sort of declining demographically, they are effectively being given a moratorium on some of their own kind of debt. How is that adding to this picture?
Okay. So in 2009, the finance minister of Japan, Kame-san, he introduced a debt moratorium. And he's officially said, we're going to get banks to lend more to struggling businesses, and they won't have to reflect the loans as non-performing. Okay? Indeed, many loans were reclassified to performing. So what's happened since 2009 is borrowers haven't been allowed to go bankrupt in essence, because the banks have been forced, and if they don't do this, they receive a business improvement order. They've been forced to do whatever they can to keep those businesses running from a cash flow perspective. That includes capitalizing interest payments. So if a borrower can't make his payment, you essentially lend him money to make the payment and the loan balance grows. Reducing principal payments, whatever they can do. And that's happened. 95% of requests for rescheduling of loans have occurred, and I've met many small businesses that have been negative assets for years and losing more and more money each year and are on rescheduled loans and sit within performing loan status, which is irregular under BIS in many different ways. So it's interesting to me because I spend a lot of time traveling around regional Japan. We're talking about regional banks where the population decline is accelerated. And that doesn't just impact the banks from a reducing customer base, but also the customers they lend to are seeing falling customer base and collapsing real estate prices. What's interesting about Japan is, when a lot of these loans were made to baby boomers in particular in the 80s, Japan had the most expensive land in the world. Okay? So there's a huge gap between the collateral value and the estimations of earnings and what's actually been going on. The issue is many of these borrowers, 10 years ago when the debt moratorium came in, baby boomers were hitting late 50s, early 60s. They just wanted to extend and pretend, so that's what the government did to buy votes, basically. Extend and pretend. Now, these baby boomers are in their 70s, and many of them are keen to exit their businesses, but they can't because they will lose their own personal guaranteed assets, their house, their car, their savings. It's interesting, the government has recently, in order to appease those voters, changed the rules. It's basically changed the rules such that those borrowers can now walk away from loans that have insufficient assets to cover the closure of that loan, so there'll be a write-down. And indeed, they can keep and remove their personal house, car savings from the recovery process under new policies. And this is seeing a very interesting increase in credit costs in Japan, which amazingly have been at around zero for 5 years, because the banks have been reducing their provisions because companies haven't been going bankrupt because of the debt moratorium, which reduces the look-back provisioning requirement. And they've reduced their provisions in the Japanese system from about 2.3% to 70 basis points, while the global sort of average of larger banks has risen to about 2.3%. So Japan's gone completely the other way, reduced provisions, which is a positive P&L impact for the banks and keeps credit costs at zero. And now you have a huge number of borrowers that can just walk away from their loans. If you just raised the credit costs for Japanese regional banks from around zero, they've risen already to about 8 or 9 basis points. But if you raise that to 40 basis points, which is still below US credit costs, and I can tell you that the Japanese regional system is far worse than any major developed economy I've seen in terms of the scale of the decline of collateral prices, the decline in earning conditions for borrowers. If you did raise the credit cost to 40 basis points, which is conservative, no Japanese regional bank would be generating a profit. And so the fact that they've understated credit costs substantially has obfuscated the fact that in their core business, they're deeply, deeply troubled, and as I suggested before, seeing an accelerated meltdown in recent months. And indeed, the FSA in Japan says that over 60% of Japanese regional banks are loss-making on a core basis. They don't then walk into the finer details of accounting tricks and hidden non-performing loans, because that would be very un-Japanese, but it's very easy, if you know how to look for it, to identify those obfuscation level tools.
This being Japan, they love their QE, etc. And people always argue that, or the lovers of Q will always say, it's not that Q is not working, we just haven't done enough of it. Won't the government kind of step in and just print loads more money and say, okay, there's now a massive hole, you're now all underwater? I mean, are they going to let the banking or the regional banking system go, or are they going to bail it out with just printing more money?
Yeah.
Is there anything changed in the way that the government is looking at bank equity and banks themselves?
So the mechanisms that Japan has used for printing money to stimulate inflation in the system are inherently negative for the banks because they suppress the transfer of interest income back to them by suppressing rates. And I don't think Japan can really reduce rates significantly from here because that will create more accountability on the Bank of Japan for blowing up the banks. I think they just prefer to keep rates where they are at the moment. They have already tried to transfer the blame to the banks by saying, look, it's you guys, the population decline is the real sort of driver for this, and also you're being too competitive, it's not our fault. So it's very clear to me that the government and regulator in Japan is unable to resolve the problems at the regional banks. And what I mean by that is, in the past, in the 90s and early 2000s, when they did let dozens of banks fail and shareholders were zeroed in some of those instances, what essentially happened is you had banks that had overlent to the Tokyo property bubble, having write-downs, and then being patched up and sent on their merry way as their main market, Tokyo, recovered and the population grew. The difference is with regional banks is you have an accelerating population decline, so it'll get worse, conditions will get worse. It's very unlikely the Bank of Japan is going to raise interest rates by 100 odd basis points to save the banks and bail them out because the consequences will be too large. These banks are sitting on assets or toxic assets that are going to get worse because they're to baby boomer borrowers who are losing more and more money each year. And so there's also very unlikely to be any white knight other bank coming in to bail them out. They all have a fairly clear idea that the toxic assets are dispersed and particularly concentrated within the weaker banks relative to their asset base. There's also a really strong aversion in Japan to bailing out banks from a political perspective. They've done a lot of work on this, done a lot of surveys, and it is clear to me that actually the appetite for bailouts is even less than you would find in Western economies. It seems the FSA is trying to warn the market by saying that 60% or more banks have negative core earnings and that banks have been understating credit costs, they officially said recently, or the Bank of Japan did it, its financial stability review, system review. They're trying to warn the market. They don't want to be accountable for buying assets that will cost taxpayers. And there is an established precedent in Japan, an established legal procedure for dealing with banks that melt down, which is you essentially split it into a good bank, bad bank. Good bank owned by the Deposit Protection Insurance Corporation, maybe those assets sold off to Japan Post. But the shareholders of the old bank get transferred into a non-viable court holding proceeding, and the precedent is those shareholders were zeroed. I think there are going to be a number of banks zeroed in Japan, and the ramifications will be substantial, as they usually are.
So what is that transmission mechanism between what is a financial crisis potentially in the regional banks to potential recession in Japan? Was GDP like a GDP in Japan? Is it fragile?
Yeah.
What's been driving that? So how does it go from something which they're flagging, they're saying this is going to happen, everyone's watching this, to actually becoming recessionary or worse? How does that happen?
When you look at sort of through the cycle GDP trends in Japan, so this century, nominal GDP has grown by less than 6%. More than half of that came from the consumption tax hike in 2014, which adds to nominal GDP, just optically, and also government consumption. And we know that Japanese government consumption, if you've travelled around regional Japan, isn't always the most productive investment in infrastructure, etc. So there isn't really strong structural growth, and indeed the reason there isn't is because the population decline. And that's accelerating. So the structural stagnancy that they've seen is only going to get worse. So what are we facing from, in my opinion, ramifications of some regional banks melting down? So Firstly, I think it'll spread to other banks quite rapidly. In Japan, you have added factors such as banks have a large amount of cross-shareholdings in each other. So when one bank starts to sell off aggressively, that impacts the asset value of other banks and the capital. Also interesting to see in past, I've spoken to financial institutions during financial crisis in Japan that will start to short other banks to hedge exposures and risks. What also is interesting to me is the banks tend to crowd into similar assets. I'll talk about the foreign assets and the implications for foreign assets later, but what we've seen, early part of this century was they were obviously crowded into JGBs, and we saw a VAR shock in JGBs. It was quite spectacular in the moves that it created. The banks have moved out of JGBs into other assets in an attempt to generate these accounting tricks I mentioned before. For example, Japanese equities. So the VAR risk is now transferred to the equity system. In addition to that, we have looked a great deal at the amount of structured product vol selling in the system that creates barriers to the downside on auto calls that once tripped accelerate equity selling and accelerate vol buying.
So is that like it's stable, and then it's not?
Yeah, correct. It actually stabilizes things, and we've gotten close in the past. Now it's interesting that these products, which used to be issued on currency and then equity indices, have been issued on or linked to the price of single bank stocks, or indeed a worst of 3 banks. And as we've approached barriers, what happens is the vol suppression has become extreme in the weakest bank. And it creates interesting opportunities in the derivative space. That's not particularly an area I focus on as much. What is interesting to me is that we're set up for a VAR shock in equities at the same time as we're set up for an accelerant to the downside in the structured product space. And the VAR shock would essentially force banks, which are also going to see impact from barriers breaking, because they often distribute these products, tightening up. Now, how I think this will impact domestic Japan, we're already starting to see it. The regulator in Japan has basically got a warning now on the level of real estate credit growth that's been occurring. It's staggering. There's more real estate loans in Japan now from a value basis than there were in 1990, the most spectacular real estate bubble I know of, okay? Even though the value of real estate has declined by about half in Japan. So that's a pretty interesting stat, right? And the Bank of Japan's obviously concerned about it, and it's essentially tightened up on the banks. And we saw last year one bank in Japan was found to have a third of its loan book were inappropriate loans to the real estate space. There were liar loans. There were loans where the underlying occupancy rates were falsified and the banks knew about it. But they just essentially, in the desperation for yield, lent into tax structures in real estate. Now we are seeing the lending appetite to the real estate space roll over. And a lot of that is because the regulator is essentially saying, look, banks, you don't have the capacity to deal with a real estate rollover. You need to tighten up your real estate lending. And they have, and we're seeing a decline in the real estate part of the economy, which is important in Japan as a delta and a sort of swing factor in the cycle. Now, broader than that, and looking globally, it's really fascinating to me to see what the banks have been doing to try and search for yield overseas. So I mentioned that 10-year US Treasuries, when FX hedge, yield negative 70 basis points. Okay. So they've got a huge hurdle for US dollar assets just to get back to earning a flat interest rate. And as I said, the break-even cost for a bank is about 1%. So they need to add another % above that to get to break even. And then they're going to try and earn yield above that to offset the fact that in Japan, they're well below break even on their most important asset loans. And the regional banks in Japan, I have found in all manner of risky assets that freak me out and freak out some of the incumbent players I speak to when they talk about the business that is being written by the banking system in Japan. That, they would never do the deals that have been done at the yield that is on offer. And, this includes, some parts of what was quite highly publicized was the US CLO market, where Japanese financial system was said to be buying more than half of issuance last year. Now, CLOs are an interesting structured product. They aren't mortgages, so maybe they don't have the same correlations that we saw for residential mortgage-backed securities in the global financial crisis. But what we have seen is the underlying loans have seen a staggering deterioration in covenant protection. And that's not just reduction of ratios required, debt to earning ratios, etc. But it's also a removal almost of lender seniority when you have entities that are failing, that have leveraged loans outstanding in the US, and you have dividends being transferred out of those entities to equity holders, and the creditors are basically being shafted because the covenant protection is not strong enough. And people I've spoken to in the CLO space have told me that level of decline would never have happened without the dominant Japanese bid coming in, and the Japanese aren't as familiar with the regulations.
It sounds a little bit like the German Landesbanks back in the 2000s when they went into all the mortgage-backed industries and thought, well, this is a nice, easy yield. So effectively, as the Japanese money effectively replaced that European money, and now they've gone into the toxic wastelands, which look good when everything's going up, but because things are bad back at home, I'm guessing there's going to be a capital flow story going on here.
So that's a super interesting thing to look at. And I just looked at the BIS numbers on banking system net foreign claims. So in the 90s, Japan was by far and away the largest gross and net lender in the banking system overseas. And it was just staggering. A lot of that was into the Asian system, which we know went spectacularly bad in the Asian financial crisis at the end of the 90s. Japan was a bit sort of shy of getting into higher risk assets during the noughties. And the Germans came in and became the top BIS banking system creditor. Okay? What we've seen since the global financial crisis is the Germans have halved their gross foreign claims, and the Japanese have doubled their gross foreign claims, and by far and away become the dominant provider of net foreign claims again. And as I mentioned to you, it's not going into US treasuries, where there used to be a dominant flow, because US treasuries are so negative yielding on a hedge basis. It's going into riskier assets and transferring a huge amount of risk in the Japanese system. Look, the interesting thing is the regulator in Japan is highly concerned about what the banks are doing. It is clamping down on those flows to some degree into riskier areas. Japan's been a dominant buyer of credit in these risky areas, so the flows are slowing, and the regulator has said it will essentially close out positions for these regional banks. They have inspectors sitting on the desks of the Treasury departments, which means we could see the dominant buyer in the past turn into a forced seller.
So this is where what we could be seeing is a kind of a small scale, it's not small scale, it's Japan, this regional issue, create an exogenous shock to the global system, because everyone's sort of saying, well, what's going to be the tipping point? And most people are looking again at the trade war. But this is something which is sort of up in the mountains, up on the north coasts in Japan, where this deterioration in the regional banks leads the Japanese banks themselves to have to effectively take profits, if they have them. We might not, in these overseas positions. So he's basically saying that there is a risk to a lot of sort of this dodgy matrix of lower quality assets in the global system, where the Japanese might be forced sellers. So it's actually in some ways, I mean, which comes first, the sort of Japanese recession, or in anticipation of a recession, they take the money out, which could potentially tip over the global system, or parts of the global system? I mean, how do you see that? What are going to be the consequences? I mean, the yen's been strengthening.
Indeed.
Is that part of it?
So sequences is quite interesting to think about. The way I look at it is, what are the things I'm most certain about? Now, there's two certainties in life, they say: death and taxes. Both of those hit the Japanese regional banks hard. So, what drives population decline? Mortality rates. They're highly forecastable. You can forecast with a high degree of certainty that regional populations in Japan will decline at an accelerating rate, which create problems for their customer base. It also creates problems for inflation, and therefore rates will remain low. The other certainty is taxes. Okay. The process of QE is essentially a tax on lenders for the benefit of borrowers. That tax plays out with a little bit of a lag because you get your new loan rate collapse, but then the old loans still outstanding have to roll down to the new loan rate. So every day, the impact of that tax is increasing on the banks as more and more loans roll over. That is a mathematical certainty. Those things I'm very, very high conviction on. We will see substantial further earnings pressure on these banks. Now, what degree of impact will that have on others? So I have a strong degree of conviction that that will impact the real estate space because it already is. And it seems like once that started in the past and they start reining in those real estate loans, that accelerates because you start to have write-downs and problems. We've got amongst real estate developers in Japan, many have record levels of inventory that they've just been holding on to and actually adding to, building new buildings that aren't selling through. And we can see the Tokyo condo contract ratio on a 3-month rolling basis has been below 70%, the danger level now, for longer than in the 90s. And that means that inventory is accruing at developers because that's the rate they sort of need to sell through. And as the banks start to shudder and melt down, the weaker ones, it'll hit the real estate space. It'll also hit other banks, as I've mentioned to you before, and I'm high conviction on that. What will happen to the economy? So, Japan has a VAT hike coming up this year in October. Previously, we've certainly seen in 2014 that sort of kick the stuffing a bit out of the consumer space. But we've already seen very weak consumer trends in certain sectors in Japan. Apparel sales have been down year over year for years now. And that's an interesting place to find weakness. Indeed, many of the retailers in Japan have been falling on a stock price basis this year, even though markets have been rising, partly because of weak consumption, also partly because their costs are rising because of a decline in labour force, which hits them on an amplified basis. So I think we are going to see problems in the real estate, retail space, and the banking crisis will just elevate that. In terms of the dollar-yen, so in my opinion, the way to value currencies is long-term real effective exchange rate. You just take the average over the period where they haven't been interfered with, which is sort of post the Plaza Accord in the mid-80s. On that basis, you essentially see all currencies oscillate around their average. That's because currencies with more inflation devalue, because inflation is inherently devalues the currency's purchasing power. And you see currencies with no inflation, like Japan, strengthen over time. What we've seen since Coronanomics came in is the yen has fallen between 20 to 25% too cheap versus its long-term average. That also reconciles when you consider the dollar on that basis is 15% overvalued with purchasing power studies which show that Japan, the yen is about 30% undervalued, and the Big Mac index. Big Mac prices in Japan need to rise about 35% to reach dollar levels if the currencies don't move. In essence, I think the yen is primed for a dramatic strengthening because carry trades under suppressed rates in Japan have weakened the yen, and the yen, I think, could strengthen dramatically. Would the banking crisis trigger that? Normally, you'd think a banking crisis should see the yen weaken. One of the guys that I trust the most in terms of understanding how financial players act in Japan, he's a key coverage point for these financial players and knows what their risk tolerance is and when they have to start closing out positions. This guy tells me that the yen would definitely appreciate under the scenario that I foresee coming, and he doesn't see any reason that the scenario I see coming won't play out. Indeed, there's actually a lot of confirmation of what I'm talking about in the media. A Bank of Japan executive recently left and said in the public forum that loss-making will become the norm for Japanese banks in the near future. I mean, that's a meltdown of their earnings that he is confirming. It's coming like a freight train. Everyone's busy looking at, the trade war or what's going on in Iran. But actually, I think the biggest risk to the system is coming like a freight train out of the biggest net foreign credit banking system melting down and imploding, and there's no brakes on that. Because if they jack up rates, they're just going to accelerate a problem in Japanese markets. As you know, as the yen strengthens, you write down foreign assets and you have a clamping down in confidence in Japan, and that would set off if a rate rise comes in Japan.
And what's the, not so much the sequencing, but what's your time frame on this? Because in the US, we've got the recession indicator saying 12 months guaranteed. Are we talking that this is something that could happen this year? I mean, obviously, it's happening on the regional banks already.
Yep.
What is the timing for them to be told, guys, you've got to do whatever you can to plug this hole, but you're never going to plug it, but bring back the capital? How does it play out? How quickly?
Yeah. So there's a great quote out of a Hemingway book. One character asks the other, how did you go bankrupt? To which he responds, well, two ways. Gradually and then suddenly. So the regional banks are tipping over from gradual into sudden, and a doubling of the shortfall in the last month of data on their loan interest income versus their break even is a sudden. This is, as I said, a very high conviction view for me that these entities will see earnings collapse to zero and then below, and they will, in many cases, see shareholders zeroed. I have a strong feeling this will roll over into other sectors, the real estate, retail sector, and internationally as it hits credit markets that are reliant on the Japanese bid, which has been the dominant bid. As I've talked through that sort of sequencing, the level of confidence falls a bit, but I'm still very confident that the impact on the global credit system will be substantial from this.
So there's trades to do that. I mean, if people can get sort of the borrow and do it, being short the banking sector. I mean, it's been a one-way ticket for a long time. And I guess the simple one is being long yen. In your view, the other bits I think one of the markets where they've been heavily reliant or heavily involved is some of these dodgy Australian credit markets. So would you be kind of, Australia's probably looking like it might have a self-created issue with its housing anyway. So would you be long maybe Australian CDS, something like that as well?
There's a huge amount of dispersion that goes on within the banks in Japan for various reasons. Some of them are more aggressive in their accounting tricks and have kept their earnings higher, but then they have a bigger blowback to come. I think spending time working on single stock equities is very fruitful from an alpha generating perspective in Japan. It seems to me that there is hardly anyone else willing to look at this. In Japan, I've been told it's very difficult to run a short fund because the regulator will make life very hard for you with extra audits and whatnot. It seems like a lot of foreigners that focus on Japan seem to be more enamored with Japan than the Japanese, often Japanophiles. I mean, I'm sure you've come across the type. And I recently met one who runs a large Japan long-short fund and said he never basically spends any time on the short book. He's just always looking for growth. I was like, you sure you're talking about Japan? So to me, I think there's a lot of alpha capture potential in the banking space in Japan, and particularly in finding those banks that have the accounting tricks. There's a lot of work, but for someone like me, it's fun, rewarding stuff. It's like, unwrapping a Christmas present on a weekly basis when I go through all their earnings. Like, whoa, look at this. Anyway, so the other implications and interesting ways to approach this are, so from an equity indices perspective, the Bank of Japan is buying ETFs in Japan. Now, my understanding is that was originally started to allow the banks to sell off cross-shareholdings in each other. So what you see is a more accelerated cross-shareholding sell-off from banks in each other, and that sector can be incredibly weak, but they're trying to keep the whole market afloat. As I said, the yen is primed to strengthen. There is macro variables globally on that are less certain, but I think they will be triggered by actually events within Japan.
And I guess one final bit around this, because I mean it's kind of interesting that this sort of little story could become a global story. Yeah. Probably not one that any of our viewers have even thought about. I mean, before you told me about it, I had never even thought that this could be the issue. It'd be more the end game. But is the Japanese story analogous with what's going on in Europe and European banks? Because one thing Raoul was talking about is which of the pockets which could break down. And clearly Europe, I mean, everyone looks at Deutsche Bank, but the banking index, he calls it the GMI worst chart in the world, the SX7E, and you put the 30-year chart, it's atrocious.
Yeah.
Is Europe actually effectively going through a fast version car crash of what Japan's been going through for the last 40 years?
So Europe definitely has a lot of the same problems as Japan. From the biggest picture perspective, European markets are actually lower than where they started this century, as are Japanese markets, and they've seen declining working age population. So there's not structural growth going on from the perspective to drive markets higher through each cycle. Interestingly, the US might see declining working age population depending on Trump's policies, and global developed markets will see declining working age population. So the stagnation that we've seen in Japan is an interesting read across quite broadly, and the assumption that markets will rise throughout cycles based on hundreds of years of rising working age population is no longer applicable to developed markets at large. In Europe and the banking system specifically, yes, they have seen a more accelerated decline in sovereign rates in some parts of Europe. What is interesting, though, is they've been less able to hide the problems. The German auditors go through the Italian banks and make sure that they're accurately reflecting, to a degree, what's going on. Now, you might say, okay, that's interesting because it creates, more stability on the confidence in the balance sheet. What's happened in Japan is because they've been hiding the problems and inflating book value and inflating earnings via the accounting tricks on the securities, it's allowed them to then be far more aggressive on the core loan business and push rates lower below break even. Now, in Europe, you haven't quite had that extent, but yeah, they're on an accelerated path in some ways towards what Japan has been doing. I think what happens in Japan is also much more broadly applicable from the perspective of markets now have confidence, as we've seen of late, that central banks can create a utopia of elevated asset prices forever. Okay? People aren't focusing on what is the cost of that. The cost is you melt down the weakest banks, which then feed out, and that's Japan, right? So I think once that happens in Japan, and everyone identifies, oh, this is the end point of these policies, then confidence in that will shatter. And we might actually see the reaction function of talking about lower rates, lifting markets and confidence, reversing, and we might actually see other central banks globally come out and admit this policy isn't actually a utopia of great asset prices, it comes with costs. And that may save a lot of the European banking system. But if it doesn't happen in Japan first, which I think is, I can't see the brakes on what's going to stop it. If it doesn't happen in Japan first, then Europe is definitely heading that way at the moment.
So finishing it off, do you see this leading to a global recession in the next 12 months? And if it does, do you see it being an evil recession or a shallow recession?
I see, unfortunately, a big washout recession that will be unprecedented in some ways. Why will it be unprecedented? The international imbalances are unprecedented in their scale. You've never seen the largest economy in the world, the US, so reliant on foreign credit after running 30 years or whatever it's been of current account deficits, while Japan has run a current account surplus and continued funding it. You've never seen such a build-up of net international investments, which is cumulative current account imbalances. Australia, unfortunately, is even worse on a net international investment deficit to GDP, and Japan has been piling into Aussie residential mortgage-backed securities for yield, and I've spoken to Aussie bankers that are just super happy to offload that to the Japanese bid and a bit bemused as why they would do it at those rates. So I think the reversal of those imbalances will be unprecedented. The scale of debt globally is unprecedented relative to GDP. The type of debt that's going on in China is unprecedented. The decline in credit standards for many corporate loans in the US is unprecedented. I recently ran a screen on US listed companies and found that 1,700 had negative equity. Not tangible equity, equity, as in their debt exceeded their assets, or the liabilities exceeded their assets. I mean, that has only been facilitated by foreigners lending more money into the US system. I think as this unwinds and we lose confidence in the mechanisms that have been used over the last 10 years to try and stimulate this reactor to get more output and have just made the financial stress greater and the meltdowns are starting to happen, it's going to take a while to build confidence and rebuild that. And Japan is one of the countries that needs the washout the most. I mean, we could talk for hours about the bad policies in Japan. You know, there is an immense shortage of labour coming, and it's just going to get worse and worse. But there is so much labour in Japan tied up in zombie businesses. 400,000 businesses have had a debt moratorium. Okay, those labourers need to be transferred to healthcare to look after elderly people in Japan, where I've been to villages and there's no one under the age of 65 to clear the snow off the roof, and the incident of death from roof collapses for elderly people shoveling snow off them it's truly horrifying. And the need for a washout and a clean out in Japan is immense. And what they've been doing, in my opinion, at Abenomics, by trying to goose up the economy by crushing interest rates and destroying the financial system, goose up the real estate market. They've reduced the approval process and incentivized the tearing down of smaller buildings and created higher buildings, and had an added tax incentive via inheritance tax structures. It's created a real estate mini bubble when the population's declining. Not a good idea, in my opinion. And they've crushed the yen to an unfeasibly low level. Even Kuroda in 2015 said the yen, which was a similar real effective exchange rate, was about as low as it could get. And the snapback will be brutal. I mean, they're just doing things, in my opinion, that are short-term goosing up. Long-term consequences are far greater.
And does this hit in the next 12 months?
Yeah, I think it's already starting to play out.
Scary stuff, really. But thank you very much for sharing that, particularly this knock-on effect, because certainly I don't think many people will be looking at regional Japanese banks as potentially being a source of an exogenous shock. Thank you very much for your time.